Now, there are several issues that are affecting the ability of African countries to raise funds. In fact, no country has been able to issue a Eurobond since spring 2022. The interest burden on public debt is rising owing to a greater reliance on expensive market-based funding combined with a long-term decline in aid budgets. The lack of financing affects a region that is already struggling with elevated macroeconomic imbalances. Public debt and inflation are at levels not seen in decades, with double-digit inflation present in about half of the countries, eroding household purchasing power and striking at the most vulnerable. Sub-Saharan Africa's economic recovery has now been interrupted, and growth is expected to decline to 3.6% this year. This is why the International Monetary Fund is advising African economies to adjust their exchange rates, basically devalue their currencies to adjust to the current global realities. Joining me now is Taiwo Oyedele, Fiscal Policy Partner and Africa Tax Leader at PwC Nigeria. Taiwo, welcome again to Business Edge. Thank you so much for joining me.
Thank you, Tolu.
So it seems that there are a lot of issues that many of our economies are struggling with right now, and we find ourselves in very tight positions. So let's start from there. Why is it that we're finding it so difficult to raise money right now?
Yeah, that's an interesting question. Yeah. So, when you're trying to raise money, you have to think about what are the motivations for the lenders, because nobody is just there to be nice to you because you have challenges. Same thing applies to countries. So as a country, if you want to borrow, you can borrow from the public. It could be domestic borrowing, or you can go to the international market and raise Eurobond. Again, still the public, just investors trying to maximize their returns. If they do the analysis of your risk versus the returns you offer them, they then make a decision as to whether they want to loan you money or not. If that doesn't work, then you have a bilateral arrangement, maybe Nigeria going to China. We've seen many of the African countries having similar arrangement with countries like China before. You could have multilateral, you could have those Bretton Woods institutions like the IMF or the World Bank. But at the end of the day, everyone is motivated by a particular reason for lending you money. Now, the challenge we've had over the past couple of years, especially since COVID-19, and then the aftermath, because COVID-19 forced many countries to print money, let me just put it that way, quantitative easing, just to put money in the hands of people to keep the economy running. We're now having to deal with the aftermath of that, such that we're having to deal with inflation that is running out of control. And that means that government is having to raise interest rates, particularly the most developed countries like the US and Europe as well. And once that happens, what then follows is that for developing and emerging economies like most of the countries in Africa, you are disadvantaged because you're seen as high risk in terms of your ability to earn foreign exchange to pay back the loans, in terms of your economic stability, sometimes even political instability. So money then start leaving those countries. You're going to have capital flights running into safety, as they will say it. What that means is the time you need money the most, particularly foreign currency, is also the time you're suffering from being able to attract foreign currency. And that just makes a bad situation even worse. Because you then have to struggle to find the foreign currency to even service the loans you've taken before in the good days, which is like the example of what happened to Ghana.
And so that's where many of us find ourselves. And interestingly enough, we also saw a very high dollar rate in the past 1 or so year. It's even said that the US dollar effective exchange rate reached a 20-year high last year, which also made it very difficult for African economies to make any money or to even raise any money. But beyond that, we're seeing that growth is expected in the Sub-Saharan Africa region to decline to 3.6% as we experience this big funding squeeze. And that's going to be tied to the drying up of aid as well as access to private finance. This is also the second year that we're seeing this aggregate demand in Sub-Saharan Africa's growth. What impact have we seen so far in the past 1 year of this situation that African economies are facing?
Yeah, I think it's a difficult time, to be honest, because if you think about Africa as the youngest continent and also the fastest growing in terms of population, you would easily conclude that a growth rate of 3% is suboptimal. You need rates that are high single digits, or even if possible double digits on a sustained basis for a number of years to even begin to make a meaningful impact. And that challenge is now complicated by one, our inability, excuse me, to attract investments, both in terms of domestic capital formation and attracting foreign portfolio and direct investments. We have seen a significant decline for the reasons that I explained before. And the reality is that there cannot be development without investments. Investments is the fuel, for you to be able to have development, which then helps you to lift people out of poverty and create prosperity. Now, on top of that is the high inflation. So when you have exchange rate problems because you don't have sufficient foreign currency to stabilize your domestic currency, you also have an exchange rate pass-through, because it means whatever you were importing before, it may be the same amount in dollar terms. It's not, because there's also inflation in the US and everywhere.
Yeah.
But even if it were to be the same amount, it will be higher in your local currency. And then when you have that inflation, unstable exchange rate, and then you have high unemployment because you cannot create investment to employ people, then the mystery index goes up. What that means is you have a lot of people who are technically and in principle just hopeless, and then they just don't know what to do, which can then fuel some crisis. So it doesn't look well for Africa, but I do think that Africa also has the opportunity to change that narrative. We don't have to always have to deal with it. If you also remember the fact that Russia did not even help us at all. Many of us didn't even realize how much we depended on Russia and Ukraine for food. This is Africa that has the largest arable land in the world. We should be feeding the world. Why are they the one feeding us? So when you add all of that together, it just gives you the recipe for a situation that is extremely complicated to deal with.
All right, so let's go to what the IMF is now advising African economies. It's saying that we should adjust our exchange rates, and that may, for many people, basically translates to devalue our currencies, saying that some adjustment of currencies seems unavoidable in many cases, even if we are looking to resist it, and we must adjust to new fundamentals. So Taiwo, IMF, World Bank, you mentioned Bretton Woods institutions. There's a history there for many of us on the African continent. The structural adjustment programs of the late 60s, 70s into the early 80s are not very far memories. And there was a series of devaluations. We've also seen some devaluations in recent times, both official and unofficial. When you're now hearing that the IMF is talking about adjustments to exchange rates, are we wrong to assume that they are talking about devaluation of several African currencies, and what really could be the impacts of that?
Yeah, I do think that the IMF is talking about currency devaluation in a nice way when you say adjustment, but if you read the details of the report, they're essentially saying devaluation. And I think it's something to take within context, right? Because it's not a right or wrong proposal or solution. It will be right or wrong depending on how it's applied and the local context to which it's being considered. So on one hand, if you don't have enough foreign currency to meet your demand, the reality is that your currency will have to devalue. You have to depreciate your currency. If you resist that and you refuse to do it, it will create market imbalances, such as we've seen in Nigeria, where you then have different exchange rates, which in turn then fuels bad behavior, because you are rewarding people who can arbitrage. If you are well connected today and you get $1 million allocation, you can just retire the following day because you make about 300 million naira overnight for doing absolutely nothing. In fact, for doing the wrong thing to the economy. So to that extent, yes, you need to allow market forces in a, I'll say maybe controlled manner to drive the exchange rates. On the other hand, you should not just devalue for the sake of devaluation because the IMF said you should devalue, because you then ask yourself, after devaluation, then what next? Because that devaluation in itself doesn't mean that you will suddenly have enough dollars, and it doesn't mean that suddenly all the demand for dollars will disappear. Especially if you look at the components of what we are importing the most. Take Nigeria, for example. Our top import is refined fuel products, right? Whether you devalue Naira or not, we still have to drive on the road. We still need diesel to be able to power many of our factories because we don't have electricity that is reliable. 8 out of our top 10 economies in Africa, their number one import is refined petroleum products. And then you have a lot of importation of food, right? Many people already have cut their ration from 3 to 2, some from 2 to 1. What else can they do? They reduce the portion of 1, right? What else would they do, right? So you want to get to a point where if you have to adjust your exchange rate, you're doing it based on a particular purpose and expected outcome. Would that lead me to be able to export more? Would that help me to be able to do domestic production to substitute for imports? Would that help my economy to be more competitive? For example, we have the African Continental Free Trade Area. So it requires a lot of thoughts in terms of what that means before you make that decision, why you are making it, and what your expectations are in the medium, in the immediate, medium to long term.
Okay, so there are some recommendations specific to where countries seem to fall in this situation. I'll quickly run through that before my next question. So the IMF has recommendations for countries that are facing inflation pressures that are induced by this exchange rate situation. It also has recommendations for countries that have government spending induced inflation, and then also for countries that have sufficient reserve barriers as well. But when you look at Nigeria, because you have mentioned Nigeria, the largest economy here on the African continent, Nigeria seems to fall into two categories of what the IMF is recommending. We have inflation pressure from our exchange rate devaluation, and we also have support for the official markets with Forex. But we also see that Nigeria's external reserves have gone from about $39 billion a year ago to just about 36.4, and it's a fluctuation. We even had a point where we supposedly were hitting just around $300-something thousand. What would devaluation mean for Nigeria's economy? I beg your pardon. What would devaluation mean for Nigeria's economy and Nigerians at this point in time with what we see as the external factors and also what are internal factors that Nigerians are facing?
Yeah, no, I do think that Nigeria falls into almost all categories that the IMF highlighted in their report. So whether you're talking about declining foreign reserve, you find Nigeria there. Whether you're talking about exchange rate induced, inflation, which is imported inflation passed through, Nigeria would also fall into that category. Nigeria also, unfortunately, is also in the category of government, quantitative easing, which we call waste and means. In fact, when I was looking at the report a couple of weeks back, ways and means is now the largest source of borrowing for government, where essentially you're printing money to spend. That fuels inflation. So you have all of that. But what I would say for Nigeria is, I think Nigeria's own solution is slightly different from what the IMF is proposing. I do not think that our solution is to devalue the Naira, because you actually have to ask yourself, which rates are we referencing? Are we talking about the parallel market rate? Or are we talking about the official rate? I think that the ideal rate is somewhere in between the two rates. Therefore, what Nigeria should prioritize is harmonization of the exchange rate. We should not be, I think today, if you're counting, you probably get to almost 10 different rates. There's one for export, there's RT200, there's one for diaspora remittances, there's all manners of rates, right? That in itself is a problem because it shuts in, investment, and you're unable to attract, FDI and FPI. So Nigeria needs to address its own issues. First and foremost, let's remove the inefficiency, the lack of transparency around exchange rate management. Number two, let's try and harmonize the rates. And you may then find that actually for us, because the market to a very large extent has priced in the parallel market. Almost everybody, even those who get the official rate, are pricing their goods and services using the parallel market rate. Mm-hmm. So if you do this diligently and you do it well, you may actually find that the rate lands somewhere in between 460 and 750, which for Nigeria will feel like an appreciation, even though it's a devaluation. And for the other countries, their solutions may also be different. What you need for Ghana will be different from what you need for Zimbabwe or for Zambia. Many of the countries in Africa are very heavily dependent on commodities. And you know what happens to commodities when the outlook for economic growth is is very unstable. So that means that this is not, unfortunately, it's not going to be a sprint. We may have to deal with this for another, couple of years.
All right, Taiwo, it's a conversation that's going to continue because it's said that this year is the year of Africa's austerity. So the debt conversation, interest rates, financing, all of those will be things we continue to talk about. And we look forward to hearing from you as well.
Thank you, Tolu.
All right, thank you.